We are moving on to securitization. We talked about, in 2016 it was a rough year in many areas except for securitization. That was a growth area. It's certainly been a way that many investors are going to access this asset class going forward. And we have with us today one of the leading experts on securitization that we have. Please join me in welcoming Ram Ahluwalia, the CEO and founder of PeerIQ.
Good morning, LendIt, and thank you, Peter and Jason, for having me here. I'm Ram Ahluwalia. I lead PeerIQ. We provide the institutional-grade data and analytics to help investors, issuers, and originators price, value, exchange, and structure the risk. In terms of agenda, I'm going to start off by framing up the themes driving securitization growth, focus on specific opportunities and challenges, and then quickly move into Q&A so I can address the topics that are of most interest to the audience. So here's a chart on the left-hand side from the Morgan Stanley research team showing the dramatic growth in marketplace lending globally. There have been some challenges in some sectors last year, but in general, the underlying growth drivers, namely the post-crisis capital and liquidity rules, have led to dramatic growth in origination volumes. Consequently, you've seen a shift from originators that have traditionally funded via retail or peer-to-peer move towards institutional funding models. So that includes bank funding, warehouse finance, whole loan sales, and also securitization. So what you've also seen more recently is the role of the capital markets function at originators has been elevated. There's been a recognition that in addition to acquiring customers at low cost, underwriting, servicing them, and developing a relationship with the borrower, that as important, it's necessary to source low-cost, sustained capital access. So here on the right-hand side, you see a rank ordering of the value propositions that borrowers care the most about when they seek a loan. Not surprisingly, better rate is the number one value proposition. And if you're an originator that does not have access to cheap deposit financing, your ability to compete and gain share and win in the market is driven by your ability to secure low-cost and sustained capital access. So if you think about what else are the traits of high-quality capital, there are a couple other features that come to mind. Number one is non-recourse. So if you've got a pool of loans that do not perform well, maybe there's a change in the credit cycle, other activity, you do not want that to imperil the going concern risk of the business. And similarly, you want a separation of the credit risk from the corporate entity, namely the specialty finance company or the originator that's manufacturing loans, from the credit risk of the pools themselves. Third, you want match funding. You want to ensure that the assets have match funding with respect to the liabilities that are funding those assets. Clearly, when there's a mismatch in assets and liabilities, there can be issues, much like we saw in the 2008 crisis. And fourth and fifth, like we discussed previously, you want to have low-cost capital and access a broader pool of investors. So it turns out securitization satisfies all of these traits. And not surprisingly, we've seen dramatic growth. What securitization enables originators to do is by separating the credit risk of the collateral that they generate from the originator's going concern and corporate credit risk, they're able to access much lower cost capital by transforming pools of loans that are illiquid into marketable securities that can be placed into the vast debt capital markets where thousands of ABS investors exist, and pensions and insurance companies and banks that have lower return requirements can now access that type of credit risk. And therefore, you've seen dramatic growth in securitization volumes. So from 2016 last year to the prior year, 2015, we saw 59% year-over-year growth. As Peter mentioned, securitization really has been a bright spot in the industry, and it really does make sense given the characteristics of that capital. Over half of the loans are now funded via ABS, and we're seeing strong investor demand, participation, engagement from ratings agencies, including AAA-rated securitizations, and a broadening of the investor base, including global investors and cross-border issuance. Each major platform has launched their own branded securitization shelf or intends to. SoFi has been the most active issuer. Lending Club, in their recent earnings report, announced that they will purchase $100 million of loans each quarter on their balance sheet. They also have a branded securitization shelf as well. It really is quite remarkable to see the level of institutional engagement in this category. Now, that's the backdrop of why securitization is growing and why it is necessary to help non-bank lenders fund and compete and achieve scale. So here's some of the challenges with securitization. What this slide shows here is the movement of credit risk. So loans are originated from originators or platformers on the left-hand side of the slide here, and the risk moves to the right, and the capital and funding moves from right to left. There are multiple different parties that have to touch the risk or finance the risk. And if the final buyers of the loans, namely the ABS investors, choose not to buy bonds because of investor confidence challenges, then dealers that provide warehouse finance will be reluctant to extend financing on the collateral pool because they'll have less ability to exit and less opportunities for the structured products teams to distribute risk. And if the dealers are not extending financing or credit facilities or warehouse lines to the aggregators or the loan purchasers, think here 40 Act funds, asset managers, credit hedge funds, then it's going to be difficult for those loan purchasers to achieve their net return hurdles, and their willingness to invest in the asset will be diminished. And finally, that'll impact the platforms upstream. So this is one of the challenges of funding for non-banks and securitization, is that you can have a funding crunch if there's a break anywhere on this chain. And we certainly saw instances that happen in Q1 of last year for some platforms, and certainly during the 08 and 09 period. Here's some other challenges as well. Number one is you have this proliferation of first-time emerging ABS issuers whose brands are not well understood in the broad debt capital markets. So they're not well known by the final buyers of the bonds. Second, the vast majority of the origination is post-2008. Therefore, there's limited underwriting history, which makes it very difficult for institutional investors to handicap the risk, to model prepayment and loss assumptions so they can project out cash flows and develop a view on, do they want to participate in the securitization, and if so, where in the capital structure do they want to do that? Third, we have not seen performance through a full credit cycle, which means that there's a risk premium that investors earn for participating in the asset class and does sideline some type of capital that's waiting for more of that performance history to manifest. And finally, there's general uncertainty because of the lack of data in the category. So for instance, on a recent SoFi securitization, SoFi is the most prolific issuer with the longest standing shelf. We saw that there's a 20% variation in the cumulative loss estimates on the collateral from multiple different ratings agencies. Funding Circle, in their inaugural securitization last year, one agency described the senior tranche as investment grade, another described it as high yield. And again, a lot of that has to do with the lack of data to help model and analyze the risk. And finally, there are a number of just regulatory issues that are out there. So where do we go from here? I'll describe where we are now, where we go, and then I'll open up to the audience for Q&A. So some market observations. Number one, we've seen really a dramatic turnaround in investor sentiment. There has been a tightening in credit spreads across the capital stack. There's been a broadening of the ABS investor base. We've seen more platforms focus on controlling their execution, driving standardization, and directly engaging with the ABS investors, typically functions provided by broker-dealers. And they're doing this to de-risk market execution. We've also seen a mild uptick in delinquencies, particularly in the personal loan unsecured credit asset. Part of that is driven by stacking concerns, which I'm sure this conference will address later, and also a renormalization of credit performance. We've come now 7 to 8 years past the crisis, and now credit bureau scores are improving, and therefore the population that's being marketed to is different than the same population that was marketed to just a couple of years ago. We're seeing variation in views across investors and ratings agencies, again, driven by these data challenges and increased regulatory scrutiny. I will say this on the regulatory front, though, is that the regulatory posture has been very constructive. Each of these regulators have said publicly that they see marketplace lending as expanding access to credit and promoting financial inclusion. So their posture is very positive for the category. In terms of the outlook, we see continued ABS growth. So PeerIQ forecasts 45% year-over-year growth in 2017 versus 2016. My personal view is that we'll actually exceed those numbers based on the fact that we now have a lending club shelf. We expect to see a Prosper shelf and other issuers join the market. We're also seeing more secondary ABS trading opportunities and potential for more ratings actions, which means that investors that have the appropriate data and analytics can find additional ways to generate performance. Third, we're seeing differentiation in platform funding costs and loss performance. So it's no longer a rising tide or a sector theme about how the category is doing. We are seeing discrete differentiation across multiple platforms. We're also seeing more of a need for data and reporting standardization. In fact, some of the recent trigger breaches that we've seen in credit facilities and the bond deals have actually become prevalent because of a lack of data standardization. So there are differences in how originators define default or charge-off or debt to income, which can create communication errors. We also expect to see new products launch that enable the illiquid consumer loans to be marketed to a broader base of investors through retail-friendly products such as 40 Act funds, closed-end funds, and also deposit-like alternatives. We also see more focus on the ecosystem going forward, an emphasis on backup servicing, monitoring credit underwriting trends, benchmarking, and attention to loan modifications. So in general, I think the main takeaway is that securitization is now generally accepted as an essential pillar of the funding for a non-bank lender, alongside institutional capital sources such as banks and other asset managers. And originators that can develop a competency in securitization can secure and build upon a competitive advantage. So with that, I think we've got about 4 minutes for Q&A.
Okay, thank you, Ram. Again, you go to channels on the app, type in your question here. First question that came in was, what is PeerIQ's core competency?
Our core competency is data and analytics. So what we do is we have data that's normalized and standardized across multiple different originators. And using that standardization, by virtue of our position in the marketplace, we have more data than any originator individually, including multiple banks. We recently announced a partnership with TransUnion, which is one of the world's largest credit reporting agencies. And by uniting the data from TransUnion with our analytical platform, we're able to help investors, issuers, originators better model out the economics. So for example, we'll work with an issuer that wants to take control of the execution so they can model out the deal economics or look at the probability of breaching triggers under various economic scenarios. We'll also help ABS investors monitor their collateral performance or help inform their trading decisions.
Okay, so how do you assess what data, how do you assess what data you don't have to model going forward?
That's kind of asking the question, is there such thing as a black swan? You
Right,
don't see the black swan, I guess. But, well, I think the key data sources that you want to look for are credit bureau data. It's highly predictive, as well as acquisition channel information, application data. You also want to benchmark that data against the peer group to understand where originators stand in relation to the borrower's priority of payments.
Okay, so how would you describe the European securitization market in comparison to the US?
Wow, that's a really sophisticated question.
And the impact of the varying risk retention rules?
Sure, well, that's the European market's very different from the US market. The European regulators, including the ECB and the European Commission, want to relax securitization restrictions that have been imposed from the 2008 regulatory regime. However, there's really been a gap between what the European Parliament wants, which was to drive higher risk retention requirements up to even a 10% level. So until we see a reconciliation between those governing areas, we're unlikely to see securitization reform. There are also just very unique differences. In the European market, for instance, insurers under the Solvency II regime are motivated to buy whole loans rather than ABS. In the US market, insurers will buy rated ABS and even extend credit facilities, but they cannot buy the whole loans because of differing capital treatment. Risk retention in the US is at the 5% level. I think issuers, I would say, are hopeful that there might be some relief on risk retention.
Okay, I think we've got time for one last question. Do you gather information from broker-dealers and ATSs?
Well, yeah, they're customers of ours. So we will load up their collateral pools and monitor their credit facilities and deliver other types of services that help them ensure they satisfy their regulatory compliance objectives.
Okay. Well, thank you very much, Ray.
Thank you all.
Thanks, appreciate it.